There are more than 310 ETFs in India right now. 90% of money in ETFs is by institutions. Keep aside 5-10% of your portfolio for tactical allocations. And we have now more than 60 plus schemes in a short span of 7 years.
Hi, I'm Renuka Verma from Mirae Asset Share Khan. Welcome to this podcast. Today we have with us Mr. Siddharth Srivastava, Head of ETF Products and Fund Manager at Mirae Asset Investments. Welcome to part 1. Thanks Siddharth for joining us. So, can you share your journey into ETF products, management at Mirae Asset, and what drew you to this space?
I was always very keen on quantitative side of things when it comes to understanding how investments work, how this entire stock picking or idea selection works. More than subjective analysis, I always liked quant-based analysis. Then my second job was into MSCI, who are one of the leading index providers globally. They are pioneers when it comes to passive investing. And passive investing is something which is rule-based, method-based. While we talk about simple indexes like NASDAQ or Nifty50, as you go more deeper, it becomes more quant-heavy, especially when it comes to ideation of any index or a strategy or a theme. So I was drawn more and more towards passive investing. Then my third job was into index development at NSE indices. And then I joined Mirae, where the job was to set up the passive investment vertical. And then since last 7 years plus, we have been building products on the passive side. We have now more than 60 plus schemes in a short span of 7 years. And I really like this space because people think that passive investing is simple. Yes, it is simple, but it has a lot of innovation which is across themes, strategies, ideas, geographies, asset classes. And especially in India, since SEBI has done categorization, you see more and more innovative products coming out on the passive side, and I really like conceptualizing new product, doing the analytics before launching a new product, and then post that talking to investors about that product or a strategy. So it's been a very fun journey because I really like to work on new things, and passive is one space which allows me to develop a lot of new things.
Nice. How the ETF market evolve over past few years, especially post 2025?
Yeah, I'll go back a bit more. Before COVID itself, the first traction came when large cap funds in a way started underperforming the benchmark. It became more and more difficult for fund managers in large cap space to generate alpha on a consistent basis. So people started thinking, why not invest in a Nifty50 index fund or ETF and remove that fund manager risk, invest at a low cost, right? That was, I think, first trigger, but it didn't started a movement which we all expected, that more and more people will come out and invest in large cap ETFs and index funds, because India is still very distributor driven, right? And distributors have played a key role in mutual fund industry becoming bigger. I think the first traction came when EPFO started investing in ETFs. Provident fund bodies started investing in ETFs, and especially in large cap space in Nifty50 and in Sensex. Government also started divesting its stake in CPSE companies through CPSE ETF and then Bharat 22 ETF. So people started, and initially institutions started realizing that this is a fantastic vehicle, a low cost vehicle with which you can take exposure, especially in large cap spaces. And then we saw a lot of institutions who run their own treasury or PF, etc. They also started investing in ETFs per se. So that was the first wave which came. and which was very institution heavy. And even now we see almost 90% of money in ETFs, around 90% is by institutions. Then I think next leg came after COVID, when we saw, due to continuous education initiatives which are taken by a lot of AMCs, including us, awareness about ETFs increased, and people started using this market volatility to buy ETFs at lower value. For example, today market is down by 2.3%. So if somebody is liking the current levels of Nifty50, he can go and buy ETFs at this current price itself. This flexibility is not there in the mutual fund, where you can only buy at the end NAV. Also, what built up was the fact that post-COVID, we saw huge spurt in demat accounts. Sher Khan is very much aware of that. We saw a lot of first-time traders, market enthusiasts coming up, and trading on exchange increasing, trading accounts increasing, and that had a direct impact on ETF, right? Because ETFs trade on exchange. You can buy and sell at intraday value. So people started taking advantage of this intraday volatility, intraday buying or selling. And also what they found eventually, I think this happened in 2022, especially 22-23 was a good time when people started liking innovative products. So we saw a lot of inflows in smart beta ETFs. We saw a lot of inflows in thematic ETFs. We have a FANG ETF and a S&P 500 top 50 ETFs. All these are very unique ETFs. So people started liking these, because what people realize that if you pick a right product well, these innovative products can add something additional in your portfolio, which is missing, right? People don't have exposure to US top 10 tech companies, so why not use FANG? People don't have exposure to, let's say, an alpha-based strategy, so why not use a Nifty 200 Alpha 30 ETF, etc. So people started liking new ideas and started using them in their portfolio. Last 1 year has been driven by flows into silver and gold ETF. So we have seen 1 lakh crore plus almost coming in I think last 12 months or so in just gold and silver ETFs. And hence, by God grace, in last 7-8 years, it was first EPFO and institutions which started investing in large cap ETFs, and it was market volatility and increase in demat accounts which propelled people to use ETFs for intraday volatility. Then we saw innovative ETFs like Smart Beta building traction more, and now we are seeing gold and silver getting money like anything, which I think has again helped the cause of ETF, taking ETF to almost every investor's doorstep.
For the first time investors, what are the top 3 advantages of ETF over trading mutual fund?
The most important aspect of an ETF is that you know what you are getting into. There are more than 310 ETFs in India right now, and there are a lot of ETFs which have different investment objective. They can probably track a particular market cap category, they can track a theme or a strategy or a sector, whatever, and they will have a set method to it. How the underlying index create the portfolio. So you have tremendous amount of visibility on what the objective of the index is and how the portfolio is created. And because of backtesting data availability, you also have visibility how that product has performed over different market cycle. So I think that's the best aspect of an ETF, because it tracks an index. Index is based on a rule-based methodology. So you are aware what is happening, and probably you are also aware what is going to happen. Can you say that about a flexi cap fund, where depending on a fund manager, you can have almost a large capish fund in the name of a flexi cap, right? Or a different fund manager can have a much higher exposure towards a mid cap and small cap and run it like a multi cap fund. So there you are more dependent on what fund manager style is, what fund manager approach is. Here you have complete visibility. Second is cost. ETFs are available at a very low cost. For example, Nifty50 ETFs roughly are available at 5 basis point, which is 0.05%. If you look at most of the ETFs, they are much lower cost compared to active funds. Just imagine if you are just lower by 1% or 0.5% and you stay invested for 7 years, that TER difference can create a huge amount of wealth creation in your portfolio. And third most important point is that there is no fund manager cyclicality or information or biasness which creeps in. A Nifty50 ETF will give you market returns and a large cap fund manager can have a value-based investment style or growth-based investment style and can perform very differently to what market is doing. And lastly, in ETF, you can buy or sell based on intraday net asset value during the day. I think that is one thing which I feel people are starting to like more and more. People track levels that no, I'll buy Nifty50 at 23,800. No, I will sell Nifty50 at 24,500. And these levels you track and you can buy and sell ETFs at those levels. So we have seen significant amount of trading because of this happening in gold ETF, silver ETF, Nifty50, bank ETF, PSU bank ETF and an IT ETF because people at times like volatility. So there are long-term investors and there are short-term tactical investors. So ETF basically provides you an opportunity to do either.
So tell us about standout product like Nifty50 and weighted ETF. What problem does this solve for investors?
Yeah. So first of all, when passive started, it was all about simply following what market is doing, right? First ETF which was launched in US was also about tracking a broad market index. In India also, the first ETFs which became popular were Nifty50 ETFs, right? Because investors just wanted to have a market exposure. And then needs changed, increased, and people started asking for more and more. Sectoral ETFs, which are pretty basics. Then thematic ETFs, which gets more complicated. Let's say a manufacturing ETF, which invests across sectors, whichever segments are participating in manufacturing story. And then you mentioned, I think, Nifty50 Equal Weight, which is a part of smart beta category. Now, for example, you may say that I want to invest in Nifty50 ETF. What is Nifty50 ETF? Nifty50 ETF is 50 stocks selected based on free float market cap. The largest company gets the largest weight. So you have HDFCs trading at 10% plus weightage. You have then Reliance and other large cap companies. So you have it's very top heavy. And typically most of the indexes are top heavy. Now I can come and say that while I want to invest in top 50 companies, I want to have equal exposure in all of these companies because as per me, going forward, probably more than top 3, top 4 companies by size, it will be the lower large cap companies which will do well. And hence my preference is Nifty50 Equal Weight. Now, and that is what we discussed in the last question, that ETFs are now so many and evolved that there will be ETF for your investment use case. So I can pick out that Nifty50 Equal Weight because I want to invest equally across all large cap top 50 companies, and you can pick Nifty50 and invest based on free float market cap tilting towards mega cap companies. The important point is that your investment experience and my investment experience will vary a lot. Usually in bear market, your product will ideally fall less because you are tilted towards mega cap companies. That is how Nifty50 is. But since my exposure is equally to all top 50 companies, probably drawdowns in my portfolio will be more. Expectation is that when markets are doing well, my portfolio will rise more than your portfolio because I'm giving more exposure to bottom large cap companies, let's say from rank 40 to rank 50, etc. So point is that there will be difference in the performance. So people should be aware about that investing in a passive product or an ETF does not mean that you are removing market risk. As you move away from basic products like a Nifty 500 or a Nifty 50, you add some amount of differentiation in your portfolio, and that can result in higher volatility, that can result in lower returns, etc. So pick the fund wisely. There are multiple funds, like I mentioned, 310 catering to different investment ideas. So don't have herd mentality. Pick the product which suits your investment objective, suits your risk profile.
Thank you so much, Mr. Srivastava. It was really well explained, all the questions.
In January, gold, silver got more money than equities. Whatever is happening on exchange is pure supply and demand, and AMC cannot intervene. It is out of our hands, sadly. So anyone who is buying any international ETF, do check INAV. I think time for ESG will come again.
Mutual fund investments are subject to market risk. Read all scheme and related documents carefully before investing.